Since the 1970s, companies have raised over $20 trillion from IPOs. And it's made some of the most iconic companies and these scrawny entrepreneurs into larger-than-life billionaires. But behind the hype and the sheen, IPOs have forever remained a mystery to the Aam Janta, especially in the age of startups. But of course, we have some exceptions. For example, take a look at this stock. Since its listing, it's given investors a return of 500%, with its price increasing over 5 times since its listing price. Now compare this with these 3 stocks, which got listed about 2 years ago, and all 3 have lost over half of their value, and investors losing 1.4 lakh crores. Now, DMart used the money raised from the IPO to actually grow its business. But that's not what's happening with the new age IPOs. In fact, a lot of these guys are getting an exit, the founders and the existing investors, and that's called an OFS. लेकिन यार OFS क्या होता है?
What's up, Abid?
Yo. Dude, tell me, what the hell is an OFS?
There are 2 sellers here. One is the company itself who issues new shares and gives it to you. The other is the existing promoter, VC, blah, 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 who are giving their existing shares to you. Now, when the company issues new shares and sell it to you, you're buying from the company and the company gets the money, right? Not the promoters, not the VCs, nobody. Company has the money.
Right.
So company spends it on important things like marketing, like scaling, like going overseas and starting a new business, hiring more people.
Growing the actual business.
Actual business, setting up more factories, producing more stuff, advertising more stuff, etc., 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 right? And if it's the latter, which is the promoter, VC, investor, etc., when they are selling, you get their shares and they get your money. The second version, that is called OFS, offer for sale.
But dude, the problem with an OFS is not that an OFS is wrong. The problem is what percentage of an offering in an IPO is an OFS. So if you're raising say 100 CR and the OFS is 10 crores, it's probably acceptable, right? Because maybe the people have invested for a long time.
Yeah,
that's
both
fine.
fight, Mara. It's legit that they
It's
get
fine.
some exit.
Correct. But if the entire IPO is an OFS and nothing's going to the company, that means there is a problem, right? Like they could not raise from private investors, or there is no alignment from the operators of the company to actually grow the business. I think a good example is Infosys.
Okay, go on.
Infosys mein basically kya tha? When they listed, there was no buyers. Let's forget about that. They actually listed at a discount.
Okay.
But the entire or a large part of the money went to Infosys with the vision that they will grow the business 100x. Of course, they grew the business many more x from there. And when an IPO happens, it's an entry for the retail investor. It's his day zero. It cannot be the operator's day end. But over the last few years, OFS has become a common part of companies going public. For example, in 2021, of the 1.2 lakh crore rupees, 61,000 was an offer for sale, which indicates that IPOs were mainly an exit vehicle for their earlier investors. But while the early stage investors have earned good returns, the Aam Janta or the retail investor has suffered. And this brings up the question, are IPOs just an exit vehicle for an early stage investor? No, actually, I think the problem is, right, ki the private markets are so extended now. There is series A, B, C, D, Z, 10.
Yeah, there's no way as a retailer you're going to get to participate in anything good stuff. Good stuff won't come to you.
But then what is the concept of IPOs and its history kya tha? Is there, can I get something to drink maybe? Like, where did all of this really start from? Like, where did IPOs and all start from? What's the history? In the 1600s, imagine, 10,000 ships would travel from Amsterdam all over the world to get spices. Now, that was a hot commodity back in the day, just like we have oil and data today. These ships were owned by the Dutch East India Company. Now, this was a risky business. Maybe about 6 out of 10 ships would actually sink. And since the risk was great, the wealthy merchants which owned the company said,
Greetings, rich-ass merchants. I think we should not take all the risk. I propose giving a small portion of the ownership of the business to the people of Amsterdam.
But how would we do that?
Simple. It's called an IPO.
It probably didn't happen like that, but the Dutch East India issued shares to the public, marking the world's first IPO. This also established the world's first stock exchange, the Amsterdam Stock Exchange. The Dutch East India Company eventually went bust in 1799, but before it went bankrupt, over 5,000 kilometers away in 1783, the concept of IPOs reached the US shores, with the Bank of North America becoming the first in the US to issue shares to the public. Soon after, the US economy started developing, and in 1906, another landmark moment took place in the history of IPOs. Banking giant Goldman Sachs helped the retail giant Sears raise $40 million. At that time, this was the largest public issue. To help it go public, Goldman pioneered what is now known as the price-to-earnings ratio, valuing companies based on their earning potential and goodwill instead of just the physical asset it owns. But what the is a price-to-earnings ratio? Let's explain what P ratio is.
Wait.
What's the formula?
Very simply put, P ratio tells you how much am I paying for how much. So basically, you take a share, you take the earnings from that share. Like एक shareholder को एक company से एक share का कितना earning मिलेगा, right? Like how much did I earn from that one share, right? Basically, you take the company's entire earnings and then you divide by the number of share. That is one share ka earning, right? Now, to get that much earning, how much price did I pay for that share? So you take the price of the share P, divided by earnings per share E. That is P by E ratio. That is how much value this thing is giving me.
Because how many times are you paying today in terms of the price of the share multiplied with the current earnings?
Same thing. Basically, how much am I paying for getting this much money?
Correct. It's like saying that there is this shop and the shop is doubling in earnings every year. So it's okay if I pay 2 times its current earning because I'm an investor.
Yeah.
It double hota rahega.
Basically, or a business is making 10 rupees every month.
Yeah.
You are paying, let's say, 120 rupees for the business. So you know that, in 12 months, I'll recover the price.
Correct.
Roughly. Of course, there's time value of money and all, but roughly. So if the P by E ratio is very high, it means that you're paying a lot of price.
Goldman Sachs really used the PE ratio to raise a lot of money for many companies. But a different story was happening in India. The Tatas were busy scripting India's first IPO. So the Tatas needed money to set up the steel plant in Jamshedpur. And they got rejected with all the bankers in London.
No, we shall not give you money for your project.
So the Tatas did something unique. They went to the Indian public and they raised a cool 2.3 crores. You would think after Tata Steel's IPO, something would have changed. But it wasn't until 1977 that Dhirubhai Ambani's Reliance went public. He raised money from 58,000 people, kickstarting the equity cult in the country.
This is the largest investment ever made on the modernization of a textile unit in the country.
Back then, the markets were controlled by the Competition Commission of India, so companies had to offer shares as low as rupees 10. And the result was an IPO euphoria. Between 1980 and 1990, the BSE Sensex shot up 7 times to 1,048 points. And just when everyone thought things couldn't get much better, in 1991, India was liberalized.
India is on the move again. We shall make the future happen.
Global brands entered the country, bringing more money into the economy, and hence the common man's income went up. A year later, the government introduced new norms and established SEBI to regulate the market. Between this period, over 4,000 companies went public. A lot of companies which went public at the time were sketchy and soon went bankrupt. Then came 1997. The party had to fizzle out at some point. SEBI introduced new listing rules and restricted companies without a proper background from going public. But on the other side, we had industrial activity which was declining globally and obviously in India. But a new chapter was unfolding. The internet came to India in 1995. It sparked an IT boom in the country, helping it become the largest software exporter in the world. globally, the 90s saw the birth of several internet companies. And all of them were going IPO, and these greedy investors gave lumps of cash to anyone with a .com in front of it. And this came to be known as the Dotcom Bubble. This is the growth of VCs investing in the US, but in 2000, it hit a new high of $30 billion. During the peak of the bubble and post its burst, India saw its number of IPOs bounce back. But everything can't always be good. It all went south soon in 2001 when Ketan Parekh's scam came to the forefront. The Ketan Parikh scam, you know about that, right?
Yeah, I've heard about that. I didn't really care about stock markets till I graduated from college, to be honest. Because I was just, I got hired out of college and was put in front of a trading screen. Usse pehle to I hardly gave two hoots about this entire thing.
Trade karo.
Huh?
And say trade karo.
Yeah. That's I was kind of forced into it. Before that, I had zero interest.
Dude, the Ketan Parekh scam, see, I will oversimplify it. Basically, they were rigging prices of stocks and pushing prices for something like 200 rupees would become 11,000 rupees. That's crazy. And these are unknown companies.
Basically, operator.
And they would do something called, what is it called when one person...
Circular trading,
right. They would do circular trading and push prices up. Okay. Now, this is basically from what we hear online, and this is what the story was.
Okay.
And SEBI basically banned Ketan Parekh on this.
Okay.
And this left a really bad taste. And this like fucked the market, man. There was no trust anymore. No one wanted to invest only. But then something good happened. We had Maruti's IPO. Maruti's story is crazy, dude. Like, I'm sure you'll agree ki they own like 50% market share. I think even today they're 45-46%. Every second car, that means a Maruti in the country.
Yeah.
But I think the IPO itself, right? Most of the money went to the business. The business actually grew and gave a 5,000% stock return. But the business also grew. It's not that the price went up. So that was nice. Maruti was one of India's favorite companies. Everyone knew the company and it did well in its market IPO debut. And because of this, everyone looked at the market and said, हमें भी invest करना चाहिए. And it started a new IPO frenzy. We had 277 companies which went public, raising 1 lakh crores. You know, the DLFs, the ICICI banks, the Reliance Petrochemical, and State Bank of India were some of the names. If you've liked this episode so far, don't forget to give a like and subscribe to this channel because we have a lot more programming coming your way. Back to the episode.
Pratik, at this point, I have to ask you a question. Have you invested in an IPO?
I would like to say no, but I actually have. I invested in the best IPO ever that hit the Indian shores. And dude, it was FOMO, man. I had rich people around me telling me to buy. And I had a system, by the way, back then even on how to trade, etc. I was short mini nifty, by the way, on pure luck. I had drawn a trend line and said, "Ye trend line toot gaya, short kar dete hain." That was the only reason.
Okay.
And the market fell. But as public markets were melting, the private markets started buzzing with activity. VCs aggressively started giving money to up-and-coming companies, also known as startups. And as the startups grew, vanity metrics go up, the VCs look to encash their bets by pushing them towards public markets. Now, among the companies they nudged to go public was the relatively young Facebook, which went public in 2012, raising $16 billion at a $104 billion valuation. Now, many early-stage Facebook investors such as Peter Thiel, Goldman Sachs, DST made massive gains from the IPO, helping kickstart the phenomena that a VC-backed startup could go public over the years and make these investors money. By 2021, this trend reached Indian shores thanks to the domestic startup ecosystem maturing, rising per capita income, and post-COVID liquidity. More importantly, there was a tweak in the rule by market regulator SEBI. Due to the onset of this bull period in 2021, the BSE Sensex gained over 10,000 points, marking another IPO boom with many companies going public, raising a record 1.2 lakh crore. And it seems like this trend isn't ending. And all these IPOs bring us to this question. Are IPOs just an exit vehicle for early stage investors? And should the retail investors stay away from it?
So here's the thing, right? I think the psychology is this, right? I think retail investors participate in IPO So if you ask me, right, I don't think there's much of a difference between an IPO and a normal share purchase. Whether you invested in the IPO of TCS in, let's say, 2003-4, whenever it was launched, or you bought it like 3 years after it was IPO'd, it's not like your returns would have varied much, right? Or even INFI IPO, right? Whether you participated in the IPO or picked up INFI like 3-4 years later, I don't know how much of a difference. I mean, ultimately, if you've done 30x, 40x, instead of that, you have done 20x, 30x, TKR, right? But I think the catch is people don't look at it that way. And the allure of there is something freshly coming in market, which everybody might have missed. Let me go get some of that. I think that's one psychology driving people's IPO.
Dude, I don't know, dude. Last year, I feel 2022, most people wanted to flip the IPO. They would buy it to sell on listing day. If you come with that mindset, I think the people who lost on the IPO, you fucking deserve it, man.
Yeah, but then that's the thing, right? I think stock markets in general, regardless of whether it's IPO or not, people should have like a 20-30 year mentality. This entire thing of IPO and flip it next month. See, the thing is this, right? You might be able to do it in one IPO. You might know 5 friends who flipped 2 IPOs. Now the catch is this, right? You said there were 3,000 IPOs. But when we were backstage and we were discussing, we had to find some good IPOs. We really had to think, right? Now, no, this is the reality, right? There are 3,000 IPOs.
That's so sad,
and
right?
we had to Google search, okay, which ones did well?
Yeah.
And you came up with some 5 to 10 names, right?
Yeah.
What people don't talk about, what is unsung, what people don't know about is the remaining 2,900 IPOs which went nowhere.
Yeah.
Right? And that's the catch. People just hear about the success stories. It's exactly like, whether I should be a cricketer or not. You can't decide to be a cricketer based on, Kohli did well, look at how rich, how good a life he's leading. You have to look at it, 3,000 IPOs, what happened to them? 3 of them went well. So then why do you want to invest in IPO? Dude, just invest in normal stock market, put SIP. It's like a quote by Naval Ravikant. Right? Naval says, everybody knows how to get rich. It's just that they want to get rich quickly.
Yeah. And that's the problem.
Pratik, no matter what you do, people are always going to do stupid stuff and IPOs are going to sell like hotcakes.
Probably.
Did someone say cake?
Thank you.
So I think the next episode should be about packaged food.
Dude, that is such a lame attempt to connect the next episode.
In the next episode, we'll talk about packaged foods and you'll get a perspective. Hit that like and subscribe. See you in the next one.